The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. We're talking about a fairly difficult subject today, which is what happens to your retirement fund money if you die, and really importantly, what happens if you've got young children and you die. And I know this is not going to be the world's most uplifting topic, but gee, it's critical. And I also know that I'm not the guy that's the expert about this stuff. So I'm thrilled to bring in David Hurford. He's the Chief Executive Officer of Fairhead's Benefit Services. Welcome, David, and thank you for joining us.
Thanks, Warren. Really appreciate your time. It's an interesting topic to unpack with you.
So maybe just to give a bit of background, we know when we're looking at the concept of money and then the difficult concept of death, from experience, my own experience, I think probably more than half of all parents in South Africa don't have a will. And, just for a little bit of background, that's the document that we need on our death so that the people who are left behind know what to do with our stuff, know what to do to who should look after our children, and might even cover things like, should we be buried, should we be cremated, etc., etc. It's a critical and incredibly important document, and it's really sad for me that a lot of South African adults just don't have one. And then the one benefit or the one comfort I feel is that we know there are a large number of people who are employed, and a lot of the companies that they work for offer retirement funds. And one of the great things about retirement funds, there are lots of great things about retirement funds, but one of them is that when you start, the person in HR is going to say to you, you need to fill out this form and you need to nominate who the beneficiaries are on your retirement fund. And that's not something that you should just ignore. That's a critical thing, because if you die, that little beneficiary nomination becomes very important to explain to the beneficiaries and everyone else involved. There'll be trustees, and we'll get into all of that now, but that'll explain to everyone what you would like to happen with your money. And so I think, if we start with that, as an important point, I just want to kind of get through, David, the beginning parts here. When you've got a retirement fund, there might be money that you've saved in that retirement fund, but there might also be an insurance benefit. And maybe we should just explain that to the people listening.
Yeah, I think that's a good place to start, Warren. I mean, I think, and I echo your sentiments around people not having a will. It's a real tragedy, because it does leave a huge gap in, what's going to happen after you die, and those that are left behind have to try and trawl their way through it. Your retirement fund is a little bit different, because theoretically you're required by your HR department to complete a nomination form. And that nomination form sets out who you want your retirement fund money to go to. Again, your retirement fund is made up of a number of different components. There's firstly the amount that you are saving every month, so the money that you put into your retirement fund every month and accumulates in the account. There's the investment return on that money, and there's some really big advantages to the retirement fund structure in terms of how it's taxed. And so there's really lots of good news stories about the retirement fund investment return. And then there is the insurance component that will pay out upon your death or your disability or those sorts of things. So it's a sort of a group risk insurance policy that's taken out either by the fund or by your employer. And it is risk graded on a group basis. And so you generally get better insurance rates on that policy than you would if you went to a sort of an insurance company direct. And that's really, really important because that component makes up a large amount of what's going to be paid out to your dependents when you pass away. I've used the word dependents on purpose there rather than beneficiaries, because one of the things I think that South Africans don't understand is that when you fill in your nomination form nominating your beneficiaries, that's not necessarily who that money will go to. And so we need to just distinguish, who makes the final decision about what happens with that money. And to try and set that kind of context for you, the retirement fund landscape has been built as part of our almost as part of our social security network, in exchange for some really, really good tax benefits that you get out of a retirement funding arrangement. What the Pension Funds Act sets out is that when you pass away, we need to make sure that your dependents are looked after. And so I draw the distinction between your nominated beneficiaries and your dependents. And that's a very important distinction, because ultimately it's your dependents who are going to receive that benefit. So I think that that's a very important point to note. So your wishes that are not, that you have nominated on your nomination form are a very good guide, as you've pointed out to earlier, to the trustees in terms of the decision that they're going to make about this benefit. But ultimately, the Pension Fund Act sets out a fiduciary duty of the trustees to look at this this benefit, determine who your dependents were, determine that level of dependency, and then look at how that will be equitably distributed amongst those dependents. They use, as I said, the nomination form as a guide, and the more information they've got, the better their decision will be, because again, they have a duty to make sure that they make sure that your dependents are well looked after. So I think that's the first point that I wanted to make about this whole retirement funding kind of upon your death.
So let's just get into that a little bit, because for some people that could be a bit of a shock. If you're a husband and your wife is employed and she dies, and she had nominated you as the sole beneficiary of her retirement fund and the life assurance that comes along with it. One of the things that's going to happen in that process is someone's going to contact you as the surviving spouse and say, we need a bit more information. And are there any children, are there any grandparents who are being looked after, etc. So they, and that's not someone being nosy. I mean, that's the job of the trustees. Obviously, they're not personally phoning; they're delegating that responsibility to make sure that it's done correctly. But they're actually trying to find out, for example, do you have children potentially from a previous marriage and you were divorced, or have you got children out of wedlock? Have you been looking after financial dependents who might not be your own children, but they could be broader family members? So the job of the trustees there, and it's a legal obligation, it's not just something they're deciding on their own, is they've got to make sure that all of those people who are or were financially dependent on the person that died, that they receive some money. And you use that word, and I know it's in the law, equitable. So in other words, it's got to be fair. They've got to try and apply their minds to doing this as fairly as possible. And that might well mean that a surviving spouse, if there are children from a previous marriage, might not get all the benefits. Some of the money might be paid to other children that just aren't part of the current marriage on the person's death.
Yeah, absolutely, 100%. I mean, I think that you've described that process very well. The Board of Trustees will delegate that investigation, and they're mandated to do that investigation around the structure of the family and who those dependents were. And it's not just children that we need to think about here. I mean, again, in our experience, we're starting to see a lot more of this as well, is elderly parents who might be in nursing homes or those sorts of things that were dependent on their children, their working children. So they would qualify as dependents. Anybody that's been looked after and maintained by the deceased member of that retirement fund needs to be considered in terms of dependency. And so, you may well be a child over 18 working already. So you are in fact a dependent of that deceased member, but there was actually no benefit that was deriving, and they weren't dependent on you financially. And so they may be not recognized as a dependent, but may not actually get any benefit distributed to them because of the equitable share component of it. So, you see that also with things like children, where there are a number of different children. One might be younger than the other. Typically, what you'll see then is the younger child getting a slightly bigger proportion of the money because they've got longer to go before they can start sustaining themselves on their own. So those are the types of things that the Board of Trustees need to investigate. They need to do a really thorough investigation. And I think for a lot of families, surviving spouses, this could be a really trying time because they've said, well, my partner said this money should come to me, and now you're asking me all these questions about our family structure and who else might benefit from this money. So I think it's very important that people understand that. Again, I'll make the point. The best thing that you can do to try and help the trustees make the right decision is to give them as much information as you possibly can. So keep your nomination form up to date. You can even write on your nomination form additional information that you think might be pertinent to the investigation. This is something that's not common, but absolutely, the more information those trustees have, the better their decision is going to be, because it is their duty to make the best possible decision in the interests of those dependents.
Yeah, I think it's a powerful point as well, is that when you get asked these questions, you might have someone that, let's say, a dodgy uncle that's lazy and actually was never a financial dependent, and now you're worrying that your dodgy uncle is going to suddenly get some of your money. That's not true. The dodgy uncle will need to provide proper information, proper proof that they were a financial dependent. They can't just claim it and say, I haven't seen them for 20 years, but they've been sending me money every month. Well, then the question will be, can you please show me your bank account statement where the money is? It was in my crypto wallet. Well, really, like we need some evidence. So I'm very conscious, that a lot of people are quite skeptical about retirement funds and not adding to them. And I just want to make the point. It's not always the case that the trustees will do the opposite of what's in your beneficiary nomination. They take that beneficiary nomination very seriously, and it does carry weight. But it is their job to make sure that everyone is fairly looked after. So I think that it's a key point there. And I think maybe also we should just talk a little bit about your, if you are, and I hope you are, one of those people that has a will and you've got a beneficiary nomination, just understand your will doesn't override what happens in a beneficiary nomination. And I think you're going to expand on this now, David, but just, your will covers the stuff outside of your retirement funds. It doesn't cover what happens in your retirement funds. And I think we should maybe just explain that as well, because you floated it past us at the beginning, but there's some great tax benefits to retirement funds when someone dies. It's terrible that the person has died, but there is a little bit of a financial silver lining there.
Absolutely. Now, look, I mean, before I jump into that, I think it's worth just sharing a little anecdote of, I get involved as a trustee on a lot of funds. I get involved in these investigations, what we call in the industry Section 37C investigations. And the number of times you sort of do the investigation and then you look at the dependents and say, well, who's getting what? And if you add it all up amongst all the people that are claiming that they've received, it far exceeds what the person was earning in the first place. So that's one of those things that you've got to really look out for. And you're absolutely right. You do need to seek out evidence that person was in fact dependent. Those trustees take it very, very seriously. That death benefit investigation, because it's a massive responsibility to decide on who's going to get this benefit. And just again, the point you made about nomination forms, they are not disregarded. It's very unlikely that they're going to be completely disregarded. In fact, you can't disregard the nomination form. So it has to be a guide, has to be one of those pieces of information that informs the decision you make. But just in terms of the retirement funding landscape versus your other assets. So remember that your retirement funds, anything held within the retirement fund space is excluded from your estate. So if you've got a will, your will deal with anything that's outside of your retirement fund, and your retirement fund arrangements will be dealt with in terms of the Pension Funds Act. And so that's really good, because not only does it exclude it from your estate and consequent estate duties and all of those sorts of things, but it can be done a lot quicker. Theoretically, it can be wound up a lot quicker than perhaps an estate these days. And so I think that's a big thing for people to understand, that they may have a will that deals with their assets outside of their retirement funding arrangements, and then they've got their retirement fund arrangements. And those include retail type retirement fund arrangements like, RAs and those sorts of things, which are completely excluded from your estate. And so, you need to think about, what provisions are you making for your dependents or your children or those that are depending on you. You have to make provision in your will, as well as thinking about your nomination form and keeping that nomination form up to date at all times.
I mean, I think maybe just to touch on one or two things there. The estate duty saving is a material, like real benefit for a lot of people. So if you're worrying about, let's say you have a sizable estate, you know you're going to die with a large amount of money, and you'd like to do whatever is legal to reduce your potential estate duty on your death. Keeping your retirement fund intact, whether they're in a living annuity or still at the pre-retirement phase where it's an RA or a company retirement fund, keeping that intact means that the money will go from you to your dependents. I'll use the words correctly now, David, not beneficiaries exclusively, dependents, and it will go without the impact of estate duty. And certainly from bitter experience, with watching, especially through COVID, when large numbers of people died, trying to wait for the master's office to kind of assist with wills being executed and estates being wound up. That was a terrible, very slow response. It's still incredibly slow, but a fairly simple retirement fund death where everything is straightforward, that can be done in maybe 3 months in a very slow environment. Sometimes it's much quicker than that, and so I think that those are two powerful points. One, it's very efficient from a time point of view. Two, super efficient from a tax perspective, and so I think that's a key point to focus on here. And David, I just thought we don't want to get into too much jargon. This is honest money. We want to keep it straightforward, but there is a difference between the kinds of life cover that you can get. And I know kind of in our briefing, you were very helpful in sending me some information about something called approved benefits and unapproved. And that doesn't mean unapproved is bad. It means it's a different style. And I thought we should maybe just get into that, because people might have one or the other. They might not know the difference, and they won't know how to identify which is which.
Yeah, look, great. Thank you. That's a great question. And I think, a precursor to all of this is that the insurance industry and the retirement fund industry have not covered ourselves in glory in terms of making the differences between these two well known to people. So you think about life cover, group risk cover, and you're going to get paid out a multiple of your annual salary, and that's great, wonderful. And when you start to dig a little bit deeper than that, you realize actually there's different types of life cover. There's what we've called unapproved life insurance, group life insurance, and approved group life insurance. Now, the difference between the two is quite simple. The first, unapproved group risk insurance, is actually an insurance policy that is owned by the employer. So your employer has taken out an insurance policy with an insurer quite separate to your retirement funding arrangements, and has nominated you as or your dependents or your nominees. You have nominated your nominees to receive that benefit. So this is theoretically, it's outside of your retirement fund. It's an unapproved policy. And so you've accessed that through a policy that your employer has purchased. An approved policy is one where the retirement fund has taken out a policy with you or your nominated beneficiaries as the beneficiaries. And so it's part of the retirement fund landscape, and as a consequence is included in the decision making of the board of trustees. So that's a very important set of distinctions. So I'll just quickly touch on that again. The unapproved is a policy owned by your employer, and an approved policy is a policy owned by your fund. So it's a subtle difference here, and you might think, well, okay, but actually there's quite a lot of difference between the two. So in an unapproved world, in an unapproved insurance policy world, you're required to nominate a person to receive that benefit. And if you don't nominate, and unfortunately a lot of people they don't keep their beneficiary fund nomination forms up to date, they don't submit them to HR, HR's continually following them up. What will happen is if you pass away, that money, the insurance company won't have a nominated beneficiary to pay it to. And so their only recourse then becomes to pay it to your estate. And so just going back to what we spoke about earlier on with, trying to stay out of the estate environment is probably quite a good idea. And so that's, again, another reason why it's so important to make sure your nomination form is up to date. If you don't complete that nomination form, you're really tying the hands of the insurance company by saying, well, we've got no choice but to pay this to your estate. So that's a very important point. The second point I think that I'll make was unapproved policies, because bear in mind, there is no discretion here. The employer doesn't have any discretion in terms of who they're going to make this payment to. They don't conduct an investigation as to who your dependents were. They simply follow your nomination form, or it gets paid to your estate. And so in the scenario where you're nominating a minor, you might nominate one of your children to receive a benefit, a portion of that benefit. You then need to start thinking about, well, where does that money go to? How does it get administered on behalf of that child, because you cannot pay that benefit to a minor child. And so then we enter into a conversation about where is that money going to be housed? Who's going to be looking after it? Somebody that you trust is going to have to look after that money on behalf of that child. And so I think that's a whole conversation in and of itself, which I think we'll get to in a sec. On the approved side, of course, because it is part of the retirement fund landscape, it forms part of the distribution decision that the Board of Trustees will make under their Section 37C responsibilities. And again, that just gives you a sense of the difference between the two. There's also some tax issues around those, but I mean, again, I don't think it's worth going into those in too much detail for these purposes. I think really to understand it, it's about the employer owns an unapproved policy, the fund owns the approved policy.
So just from personal experience, looking at the cost, you mentioned it right at the beginning. When you take out a life assurance policy for yourself in your own name, the life insurance company looks at you and they rate you, and then they charge you a fee for giving you the cover. And almost always, I can't think of an example in my career where I've seen that form of life assurance be cheaper than if you get the same amount of cover offered to you in your retirement fund. So just understand that the retirement fund, when they're insuring you, they're insuring you as part of a group, and the more people you add to a group, the lower the risks are. Somehow the actuaries have worked that out. It makes a lot of sense. And so being able to take life assurance or even disability insurance and rare disease through your group scheme, your company scheme, I think is a huge benefit that you should really consider. And certainly, price-wise, makes all the sense in the world. I'm conscious of time, David, and you've raised a very good point there. So let's get into that, where you've got money, you've got children that are 11 years old and 13 years old, let's say, and now you die, and that money really shouldn't be paid. Let's say it's 5 billion rand. It shouldn't be paid to an 11 and a 13-year-old. That's no sensible financial planning. So what are the options there for making sure that money is used for their benefit in the correct way, and not to go and buy the latest accessories and business class seats to Vegas?
Yeah, absolutely. I could argue that even paying that money to an 18-year-old, which you can do, you probably shouldn't. When I was 18, I probably shouldn't. If somebody had given me 5 million rand, I'm not sure it would have ended well. But yeah, look, you can't pay those benefits to a minor nominee or minor dependent. And so you have to figure out what you're going to do with that money. Where is it going to go? And you've got a few options. You can, if there's a surviving spouse, a legal guardian of those dependents, then clearly that's an option. You can pay it over to that person, and they will look after that money on the child's behalf. It does come with a bunch of risks, and proper estate planning will help you through that process. Because if I give a surviving mother, a whole bunch of money to look after for her kids, legally her responsibility is to look after that money for her kids. But of course, now she's sitting with that in her bank account. It's not ring fenced. She's probably going to put it into a unit trust, hopefully. And now who's going to pay the tax on that unit trust? Who's going to deal with the financial decisions, the investment decisions of that money? How's she going to make decisions about using that money for their benefit? So that's the first option, is obviously to pay it to the surviving spouse. The second option, and unfortunately in South Africa, we are faced with this one, which is there are a lot of single parent households, heap of single parent households. And so when the parent dies, there isn't a surviving spouse to take over and look after that money. And so what we have then in the Children's Act is this definition of a caregiver. And that caregiver is not a legal role, but it's effectively who is actually or factually looking after those children. Typically, it falls to an auntie or a granny or those sorts of things. And in theory, what you should be doing is going through a court process to be appointed as a curator of that individual, or go through some legal process to obtain legal guardianship of that child. But that very rarely happens, just because of the cost and the complexities of it. So in South Africa, we're dealing with this notion of a caregiver. And so, do you pay that money to that child's caregiver? In my view, that's a very risky thing to do. And it's arguable that it actually doesn't satisfy the claim that child might have against the insurance company or against the retirement fund when they do turn 18 and they come along and say, well, where's my money? It's been squandered. So there would be a case to be made that money wasn't paid, that claim wasn't satisfied because it was never paid to the minor. And then the third option is to look at some sort of a structure, such as a beneficiary fund or an umbrella trust or a single trust structure that might house that money in trust for the benefit of that child until they reach a certain age, and they can then take over that benefit themselves. A lot of the time, people that have been through an estate planning process will end up with what's called a will trust or a testamentary trust. And then upon their death, that will becomes essentially the trust deed, and that can then be registered with the Master of the High Court, and that it can become a trust. And there are a whole bunch of requirements that come along with going that route. For smaller estates, for smaller amounts, you'd really have to think very carefully about whether or not it's economically worthwhile to do that. Running a trust is expensive. You've got trustee fees. You've got a whole range of professional fees. There's the requirements from SARS now. There's requirements from the Master of the High Court in terms of beneficial ownership registers. All of those things add to the complexity and the compliance of trusts. So if you've got a smaller amount, you can then consider things like an umbrella trust solution, which is a pre-existing single deed where many thousands of beneficiaries that are unrelated to each other can participate in that trust. So it's effectively an account, a sub-account within that trust structure that is a much cheaper option for smaller amounts, say under 1.5 million or something like that. In the case of retirement fund money, so now we're talking about money that's coming from your retirement fund, either your group life or your fund credit, that can actually go into what's called a beneficiary fund. And our beneficiary fund is a vehicle that was established in 2009 by the FSCA, or then the FSB, the Financial Sector Conduct Authority, in response to some wholesale fraud that happened in the early 2000s with Fidentia. I'm sure many of your listeners will remember Fidentia. So in the old days, what used to happen with that money from retirement funds is used to be put into trusts until, of course, the Fidentia scandal happened and all of that money was stolen. And so the government's response was, well, let's create this vehicle called beneficiary funds, which is a pension fund organization. Its main piece of legislation is the Pension Funds Act itself. It's a completely tax-free environment because it is a pension fund organization, and it carries the same burden of regulatory oversight that all pension funds do in South Africa. And so that's an option. That becomes an option for any retirement fund money that's due either to minor dependents or, in fact, elderly dependents. We've seen a lot of that coming through as well, that can be housed within those beneficiary funds. So it's a very similar kind of structure. It's based on a trust structure where that money is held. It's vested in the name of the child, but it's held on their behalf until they reach age of majority or some other condition is met.
So and just my own comment there is that you can take comfort from the fact that it's a professionally, properly managed thing. It's extremely well regulated, It's not going to go into some cabinet member's new holiday house. It's not possible for that to happen. And very similar to kind of, the normal private retirement funds we see in South Africa, highly regulated, and extremely transparently managed, which is valuable. And I think it's a very nice alternative when you've got if you are a single parent or you've got older parents potentially who might not have, if they've got dementia or something like that, where you're extremely worried about them. Using a vehicle like that becomes very nice, especially when you're not sitting on tens of millions of rands, where maybe a trust would be a viable and cost-effective alternative. David, we could keep going for a long time, but we've blown through our time frame, and I've still got to ask you my favorite question to all new guests on the show is if you could go and meet your 21-year-old self with the benefit of some life experience now, what would be the one life lesson that you would love to teach yourself?
Sure, Warren, that's a tough one. I mean, I think for me, I think it would probably be something along the lines of take more calculated risks. Back yourself, because there's massive opportunities that perhaps through lack of confidence in your youth or whatever the case may be, you don't necessarily grab with both hands. So that would probably be the advice to my 21-year-old self: is take more calculated risks, back yourself, and take advantage of the opportunities that come up.
Fantastic. I love it. David Hurford, CEO of Fairheads Benefit Services. Thank you so much for joining us. I actually learned a lot, and I've only been doing this job for 30 years. So thank you for sharing your insights with us. And we hope everyone else that's listening will get the same benefit. Appreciate having you on the show.
My absolute pleasure. Thank you, Warren.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.